After studying this module, you shall be able to know the meaning of balance of payments, understand why countries maintain balance of payments accounts, learn about the components and structure of balance of payments account, understand why the balance of payments account must balance, learn how balance of payments account is recorded in India, learn how current account deficit may be financed.
We are aware of the fact that the National Income Accounting Framework of a nation provides estimates of aggregate income and expenditure of a nation. Exports and imports of goods and services are recorded within this framework. However, it does not give a complete account of all the international economic transactions, such as those involving real and financial assets. A separate set of accounts are maintained by each country that record all international transactions between the government and residents of a country and foreigners, including foreign governments. These are known as balance of payments or BOP accounts. A clear understanding of BOP accounts is very important, as the progress of each nation is increasingly becoming dependent on how much it is integrated with the rest of the world, especially during this current era of globalization. The balance of payment accounts consist of two main components, current account and capital account. The balance of payments account provides information on important aspects of a nation's international position, financial position mainly. For example, it gives a picture whether a country is net debtor or a net creditor. Such information would be of interest to foreign investors, other trading countries, and international organizations. It is also useful for the government, as it can formulate economic policies, the domestic economic policies, accordingly. Let us study more on this in detail.
The National Income Accounting Framework of a nation provides estimates of aggregate income and expenditure of a nation. Exports and imports of goods and services are recorded within this framework. However, it does not give a complete account of all the international economic transactions, such as those involving real and financial assets. A separate set of accounts are maintained by each country that record all international transactions between the government and residents of a country and foreigners, including foreign governments. These are known as the balance of payments accounts. A clear understanding of balance of payments accounts is very important, as the progress of each nation is increasingly becoming dependent on how much it is integrated with the rest of the world. The balance of payments account consists of two main components, current account and capital account. The balance of payments account provides information on important aspects of a nation's international position, example, whether it is a net debtor or a net creditor country. Such information would be of interest to foreign investors, other trading countries, and international organizations. It is also useful for the government, as it can formulate economic policies accordingly. In what follows, these issues are discussed in detail. Balance of payments refers to a systematic record of a country's economic transactions, both trade and financial flows, with the rest of the world during a specific period, typically a year. The balance of payments account has two main parts, the current account and the capital account, separated by a line. Let us start by studying current account. The current account records transactions involving a country's trade in goods and services, including factor services, with the rest of the world, and it records payments made to and received from foreigners in this regard. Any transaction is recorded twice in the balance of payment account. In general, transactions involving the inflow of foreign exchange are recorded as a credit entry in the current account, with the corresponding debit entry appearing in the capital account. The current account has three main components: the balance of trade in goods and services, net investment income, and net unilateral transfers. You may note that the transactions involving trade in services, factor incomes, and transfers are also referred to as invisibles in the current account.
Balance of trade in goods and services. The difference between exports and imports of goods by a country is captured by balance of trade, often called merchandise trade balance in the current account. The balance of trade may be positive, negative, or zero. A positive balance of trade indicates that the country's exports of goods exceed imports, and the country is said to have a surplus balance of trade in this particular case. On the contrary, when imports of goods exceed exports, the country has a negative balance of trade, which is very simple. I am sure we all understand this. The balance of trade in services is a part of invisibles, and it reflects the difference between a country's service exports and imports. It may also be positive or negative depending on whether the country is a net exporter or net importer of services. And it is similar to the trade in goods. Services include shipping, transportation, travel, tourism, banking, insurance, education, consulting, and other miscellaneous services such as software, etc. As we discussed earlier, in the current account, the value of exports is a credit as the exporter earned foreign exchange, representing an inflow of foreign exchange, while the value of imports is a debit as importers have to make payments in foreign exchange, representing an outflow of foreign exchange. Movement in trade balance impact on the demand and supply of foreign exchange with implications for the exchange rate, especially under the flexible exchange rate regime.
The balance of trade in goods and services. The difference between exports and imports of goods by a country is captured by balance of trade, often called merchandise trade balance in the current account. The balance of trade may be positive, negative, or zero. A positive balance of trade indicates that the country's exports of goods exceed imports and the country is said to have a surplus balance of trade in this case. When imports of goods exceed exports, the country has a negative balance or trade deficit. The balance of trade in services, part of invisibles, reflects the difference between a country's service exports and imports. It may also be positive or negative, depending on whether the country is a net exporter or net importer of services. Services include shipping, transportation, travel and tourism, banking, insurance, education, consulting, and other miscellaneous services such as software. Another component is investment income. Indian residents may receive investment income such as dividends and interest on the foreign assets they hold, while foreign residents receive investment income on the Indian assets they possess. The former is recorded as credit and the latter as debit in the balance of payments account. Let us understand this with the help of an example. Dividend payments made by multinational firms operating in India to their shareholders abroad would result in a foreign exchange outflow, and it would be recorded as a debit entry in the current account. The net investment income from abroad is investment earnings from abroad by Indians minus foreigners' earnings from their assets based in India. Third component is unilateral transfers. Overseas payments made without any quid pro quo, such as assistance by foreign governments during war or natural calamity, workers' remittances, example money sent by Indian workers employed abroad to their families in India, personal gifts, donations, etc., are recorded in the current account. The net unilateral transfers are transfers received by Indians from abroad minus similar transfers sent to foreigners from India. These transfers are generally negative for developed countries such as the US, as it has very little restrictions on sending money out of the country, whereas in many developing countries there is a net credit balance on unilateral transfers, especially due to workers' remittances, which can be an important source of foreign exchange earnings. The balance on current account is the sum of the A. Balance on merchandise trade, B. Balance on invisibles, which comprise balance on services trade, net investment income, and net transfers. When total foreign exchange receipts on account of all the transactions recorded in the current account are greater than total payments, the country has a current account surplus. In case foreign exchange payments exceed receipts, the country has a current account deficit. It is interesting to note that a country could have a current account surplus even if it has a trade deficit if net transfers from abroad are positive and extremely high. This could be true for many countries that receive high transfers. For instance, India has one of the highest remittances received from the rest of the world. Using the national income identity, we can show that when a country's aggregate income exceeds its aggregate expenditure, which is C plus I plus G, it runs a current account surplus and the current account balance is positive. GNP minus aggregate expenditure, which is C plus I plus G, equals GDP plus NFIA minus the aggregate expenditure, C plus I plus G plus X minus M plus NFIA minus the aggregate expenditure equals export minus import plus NFIA, which equals current account balance. The above identity indicates that a country with a current account deficit or surplus is one for which aggregate domestic consumption, which is C plus I plus G, exceeds or falls short of aggregate income. A country with a current account deficit is a net debtor as it has to borrow to bridge the gap between income and expenditure. A country with current account surplus is a net lender. A current account deficit may be financed by borrowing from the rest of the world or by reducing holding of foreign assets.
After discussing current account, let us now discuss the second account, which is known as the capital account. Transactions involving cross-border purchase and sale of real and financial assets are recorded in capital account. All transactions are recorded twice, once as a credit and once as a debit entry in the capital account. This captures the two aspects of each transaction. For instance, purchase of a foreign asset by a domestic resident involves an asset import against which there is a capital outflow. Payment made by the domestic resident for the foreign asset. The asset in question could be physical assets like land, factories, houses, or financial assets like stocks and bonds. Broadly, two types of capital flows are recorded in the capital account: debt creating and non-debt creating flows. When domestic firm borrows from the foreign bank, the country experiences a debt creating capital inflow, as this loan has to be repaid at a future date. However, foreign firms investing in the domestic country, for example, foreign direct investment, or which is known as FDI, involves a non-debt creating capital inflow, as this does not create any commitment for repayment for the recipient nation. Another way of classifying capital flows is by the duration involved. For instance, foreign institutional investors, FFIs, purchasing domestic stock involves a short-term capital inflow. Such investment in company stocks and bonds by foreigners is referred to as foreign portfolio investment, or FPI. The FFIs may sell the shares and withdraw their funds at short notice. Such withdrawal of foreign funds would involve a capital outflow. Typically, investment by foreign firms in country's production sector involves longer-term capital inflows that are not likely to be withdrawn as fast as the investment in the financial sector.
When capital inflows exceed capital outflows, the country has a capital account surplus. In the reverse case, when outflows exceed inflows, it has a capital account deficit. The third component of balance of payment is errors and omissions and official reserve transactions. In principle, as each transaction is recorded twice, once as a debit entry and once as a credit of the equivalent amount, under the double entry system of bookkeeping, the balance of payment always balances. However, in practice, this never happens, largely due to data availability problems that arise due to the time lags involved in the international transactions. For instance, data on exports may be collected at the time the goods are shipped from the country. However, the payments for exports are made 9 months later and may not be recorded in the balance of payments of that year. Therefore, in order to balance the balance of payment account, an item for errors and omissions is included. You may wonder about the above point. If the balance of payments always balances, allowing for errors and omissions, then why do we talk about a country running balance of payment surplus or a balance of payments deficit? The balance of payment surplus or deficit refers to the sum of current account and capital account balances. In case a country has a current account deficit of say $10,000 but a capital account surplus that is larger in magnitude, say $12,000, then it has a balance of payments surplus of $2,000. Similarly, when there is a current account deficit and a capital account deficit, or a capital account surplus smaller in magnitude than the current account deficit, the country experiences a balance of payments deficit. To further understand the implications of a balance of payments surplus or deficit, note that the capital account essentially includes two kinds of transactions: transactions among government agencies and private individuals, and buying and selling of foreign currency by the country's central bank. These are recorded separately and are known as the official reserve transactions. With the balance of payment surplus, there is a corresponding addition to the stock of foreign exchange reserves maintained by the central bank. Such an addition to foreign exchange reserves appears with a negative sign in the balance of payments, as it is equal in magnitude but opposite in sign to balance of payment surplus, hence ensuring that overall the balance of payments is in balance. Similarly, when there is a balance of payments deficit, there is a depletion of the central bank's foreign exchange reserves that appears with the positive sign in the capital account of the balance of payments. In this sense, the overall balance of payments must balance. That is, the sum of balance in current account, private capital account, including errors and omissions, and official reserve transactions must always balance, that is, must be zero. That is, balance of payments equals current account plus capital account plus official reserve transactions equals 0.
In India, RBI, that is Reserve Bank of India, is responsible for compiling and disseminating the balance of payment statistics. These are maintained on the guidelines of International Monetary Fund, that is IMF. Balance on current account is reported quarterly now. However, merchandise trade balance is reported monthly. The data on merchandise trade is collected from both the Director General of Commercial Intelligence and Statistics, known as briefly DG CI&S, and by RBI. To illustrate the balance of payment account further, table presents India's balance of payments from 2010-11 to 2012-13, which will add clarity to your understanding of the balance of payment account. As explained earlier, balance of payment consists of current account, capital account, and the third is errors and omissions and change in foreign exchange reserves. The current account includes merchandise, which is exports and imports, and invisibles. The invisibles include services, incomes, and transfers. The merchandise imports are greater than exports in the 3 years presented here, indicating a negative trade balance or trade deficit. The capital account includes foreign investment, both FDI and FFI. It also shows loans, which is external assistance, external commercial borrowing, and trade deficit or trade credit, and banking capital, which includes NRI deposits. All the components of capital account appear with a positive sign, indicating a capital account surplus. The capital account surplus is computed by summing the items from A to E. The overall balance of payments is the sum of current and capital account, which is item 5 in our table 1. As we can see from this table, it is positive in the year 2010 and 11 and in year 2012 and 13, while it is negative in year 2011-12. The positive overall balance has resulted in 2010-11 and 12-13 as capital account surplus exceeds current account deficit. As a result, there is an increase in the foreign exchange reserves by the same amount, which is shown by a negative sign in reserves, which is item 7 in table. Now that we have understood the working of balance of payment account, let us know the options available for a country to finance its current account deficit, which is our item 3 in the table.
Another question that we need to ask is that how is current account deficit financed? We have seen that a country has a negative current account balance or current account deficit when its aggregate income is less than its aggregate expenditure. The problem of financing the current account deficit essentially refers to the ways in which the country bridges this gap between aggregate income and expenditure. A current account deficit by itself may not be a cause of concern if the underlying reason for it is linked to high levels of spending on productive investments. Such investments are likely to enhance productive capacity of the economy and hence create capacity for export and reduce the deficit in the long run. However, if the current account deficit is high due to unproductive expenditure on consumption, this may be problematic in the medium to long run. In this case, the current account deficit might lead to growing international debt burden without creating any condition to repay such debt via foreign exchange earnings. You may note that financing of the current account deficit essentially refers to the composition of capital flows and reserve transactions recorded in capital account that offset the current account deficit. Current account deficit may be financed by net capital inflow into the country in various forms: foreign direct investment, foreign portfolio investment, external borrowing, foreign asset reserves. Foreign direct investment or FDI. Foreign exchange can move into the country when multinational companies intend to expand operation in the country. This could be done by establishing new subsidiaries or by acquisition of already existing domestic firms. This is a long-term stable source of capital inflows. Foreign portfolio investment or FPI. Foreign exchange can move in when financial institutional investors such as mutual funds, pension firms, or other financial entities make financial investments by purchasing bonds, equities, or other such financial assets. These are short-term capital flows that may be withdrawn at a short notice. As such, this is a volatile type of capital inflow. External borrowing. To finance its current account deficit, a country may borrow from foreign governments or international agencies like IMF, World Bank, etc. However, excessive borrowing may lead to a crisis situation wherein countries find it difficult to repay foreign debt. Several European nations like Portugal, Ireland, Greece, and Spain have faced an external debt crisis in recent times. Foreign asset reserves. The country may reduce its holding of foreign assets to finance current account deficit. This is usually through the sale of foreign currency by the central bank from its stock of reserves. The current account deficit may therefore be financed by foreign direct investment, foreign portfolio investment, borrowing externally, or depleting the stock of foreign assets.
We learned in this module that balance of payments refers to a systematic record of a nation's economic transactions with the rest of the world during a specific period. The current account records transactions involving exports and imports of goods and services, investment income, and unilateral transfers. We have also learned that balance of trade includes only imports and exports, while balance of payments is a much wider concept and includes all receipts and payments in current and capital account. Transactions in the capital account involve purchase and sale of all kinds of assets such as debt or equity for a short or long period, such as foreign direct investment and portfolio investment by foreign institutional investors, loans and banking capital, as well as real assets. We have also learned that the balance of payment account is based on the basic accounting principle in which each transaction is recorded twice, which is a credit and on debit sides. In India, Reserve Bank of India is responsible for compiling and disseminating these statistics in balance of payment account. I am sure you have also understood so far that the negative current account balance or current account deficit may be financed by foreign direct investment, foreign portfolio investment, borrowing externally, or reducing the stock of our foreign assets. Thank you.
Let us summarize what we learned in this module. Balance of payments refers to a systematic record of a nation's economic transactions with the rest of the world during a specific period. The current account records transactions involving exports and imports of goods and services, investment income, and unilateral transfers. Balance of trade includes only imports and exports, while balance of payments is much wider and includes all receipts and payments in current and capital account. Transactions in the capital account involve purchase and sale of all kinds of assets such as debt or equity for a short or long period, such as foreign investment consisting of foreign direct investment and portfolio investment by foreign institutional investors, loans, external borrowing, external commercial borrowing or trade credit, and banking capital as well as real assets. The balance of payments account is based on the basic accounting principle in which each transaction is recorded twice, both on credit and debit sides. In India, Reserve Bank of India is responsible for compiling and disseminating the statistics in balance of payments account. The negative current account balance or current account deficit may be financed by foreign direct investment, foreign portfolio investment, borrowing externally, or reducing the stock of foreign assets.